Hey everybody, Kamari Ellis here with another edition of Ask Kamari's Investing Basics Challenge. Today is day number 21, and we're talking about asset allocation today. But before we talk about asset allocation, I'm pretty sure all of you have made a cake at some point with your mom or your grandma, your nana, your mama. And you gotta get all the ingredients and you gotta mix them up and you gotta whip it up in the bowl. And if you're good, you might get to lick the bowl, or at least that's what they used to do in my family. Probably why I love sweets and got all this extra fat on me, but that's another story for another day. But, investing is very similar to baking a cake, and asset allocation is very similar to baking a cake. So just like a cake, you need your ingredients, you need your milk, your butter, your sugar, your flour, whatever other ingredients you might need, your icing as well. Just for your investments, you need an asset allocation. What's your mix of stocks, bonds, cash? Now, stocks, bonds, cash, that's normally your typical or your traditional asset allocation. I hate that. I don't like anything traditional for the most part. When I think of asset allocation, I think of stocks, bonds, and cash, but I also think of real estate. I also think of commodities. I also think of currencies and how all of those different things will factor into a customized, personalized investment portfolio made for you. So, each one of those different things. Now, let me back up. I think of all of those things also domestically here in the United States and also abroad globally as well. So all of those things, your bonds, your stocks, your equities, your commodities, your currencies, they all have different characteristics. They all have personalities. They all bring something different to the cake flavoring. So they act differently under different stresses or under different environments or under different factors. So usually in times of war, like we have Russia going on right now, bonds usually do really, really well. Stocks, not so much. Times of high inflation, basically when people are getting a lot of raises and when people are doing relatively well in the economy, you'll see commodities go up because people are demanding more. Also, if you see population growth, you may see commodities go up as well because people are demanding more food. People might be demanding more clothes. People may be driving more as well. And oil is a commodity, so you might need that for your gas. But again, asset allocation is just the overall mix of your portfolio. So, a typical asset allocation, you may hear people say a 60-40, and they may be talking about a 60% of your portfolio being in stocks, 40% being in bonds, and another one you may hear is 70-30, again, 70% in stocks, 30% in cash. Everybody's asset allocation should be different. There's no one right asset allocation or cookie cutter approach to developing an asset allocation for a person. So it all depends on what you need, what best works for you, like a custom-made suit. Nothing fits like a custom-made suit. So you want to tailor it, and you can do that. That's asset allocation, kind of a rough and dirty mix of it. Tomorrow is video number 22. 22, we're just going to go over various investment risks, some things you need to think about, and how to react or how to at least process it once these things happen. All right, so again, that's day 21. We talked about asset allocation. Don't forget to subscribe to the YouTube channel. Share this with your friends or family or any of your loved ones who you think need investing education. And I'll see you back here for video number 22. Bye-bye.